This is part 1 of the presentation for Module 3 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs. In this module, we will explain several measures of performance that relate the income statement to the balance sheet. We will also identify factors that drive these performance measures and how to interpret them. In this learning objective, we will learn how to compute and interpret return on equity. The most common analysis metric used by managers and investors alike is return on equity, a power summary measure of company performance defined as net income divided by average stockholders' equity. ROE relates net income to the average total stockholders' equity from the balance sheet. It measures returns from the perspective of the company's stockholders. Return on E is an important metric, and in the 5 years from 2014 to 2018, return on equity of the S&P 500 firms ranged from 13.5% to 15.6%. The S&P 500 index is a market capitalization weighted index of the S&P 500 firms. In this chapter, we will be using Boston Scientific to illustrate profitability analysis. Boston Scientific's return on equity for 2018 was 21.24%, as shown on this slide. Return on equity is a summary return metric that measures the return that the company has earned on the book value of the shareholders' investment. It is one measure of how effective management has been in its role as stewards of the capital invested by shareholders. The Standard & Poor's 500 consists of roughly 500 of the largest publicly traded companies and accounts for about 75% of the U.S. stock market capitalization. U.S.-based companies are selected for inclusion based on market cap, industry, long-term profitability, trading volume, and other factors. In 2019, Boston Scientific was number 97 on the S&P 500 list. In this learning objective, we will apply DuPont disaggregation of return on equity into return on assets and financial leverage. Disaggregation of return on equity was initially introduced by E.J. DuPont de Nemours and Company to aid its managers in performance evaluation. DuPont realized that management's focus on profit alone was insufficient because profit can be increased simply through the purchase of additional investment in low-yielding but safe investments. To disaggregate ROE, you can divide it into components which provide a different perspective to inform your analysis. The traditional DuPont analysis disaggregates return on equity into components of profitability, productivity, and leverage. The second method extends the traditional DuPont analysis by taking an ROE analysis with an operating focus that separates operating and non-operating activities. This slide illustrates the components of DuPont disaggregation of ROE. First, we have ROA, which is calculated as net income divided by average total assets, and then financial leverage, which is average total assets divided by average stockholders' equity. This disaggregation reflects both company performance as measured by ROA and how assets are financed, which is measured by the relative use of liabilities and equity. ROE is higher when there is more debt and less equity for a given level of assets because the denominator in ROE, equity, is smaller. However, there is a trade-off because using more debt and less equity results in higher ROE. The greater debt means higher risk for the company. Return on assets measures return from the perspective of the entire company. This return includes both profitability in the numerator and total company assets in the denominator. To earn a high return on assets, the company must be profitable and manage assets to minimize the assets to the level necessary to achieve its profit. Most operating managers understand the income statement and focus on profits. However, many of the same managers fail to manage the balance sheet. ROA analysis encourages managers to focus on the profit achieved from the invested capital in their control. Boston Scientific's return on assets for 2018 was 8.35%. From 2014 to 2018, the median ROA for the S&P 500 firms ranged from 5.2% to 6.1%, and the median in 2018 was 6.1%. Managers must seek to increase profits with the same level of assets or decrease assets without decreasing the level of profits to increase ROA. It is this dual focus that makes return on assets a powerful performance measure, focusing managers' attention on both the income statement and the balance sheet. Financial leverage is the second component of ROE, and it measures the degree to which the company finances its assets with debt versus equity. There are many ways to measure financial leverage. In the DuPont system, we measure financial leverage as the rates of average total assets to average stockholders' equity. Measuring financial leverage is important because debt is a contractual obligation, and a company's failure to repay principal or interest can result in legal repercussions or even bankruptcy. As financial leverage increases, so does the level of debt payments, which, all else being equal, increase the probability of default and possible bankruptcy. This slide shows the financial leverage of 2.54 for Boston Scientific in 2018. The median financial leverage for the S&P 500 firms for 2018 was 2.66, and the median ranged from 2.46 to 2.74 from 2014 to 2018. Comparing a company with a measure such as the S&P 500 firms allows for context in interpreting ratios. When computing return on assets, we use net income in the numerator and the average stockholders' equity in the denominator that is attributable to the common shareholders. This means that if the company has issued preferred stock, we need to make two adjustments to the ROE calculation. In the numerator, we need to subtract preferred dividends, and in the denominator, we need to subtract the average preferred stockholders' equity. Another adjustment is to determine the ROE for the controlling stockholders, excluding the shareholders who own stock in a subsidiary but not in the parent company. If a company has non-controlling interests, then the balance sheet will separately identify the stockholders' equity related to each group, and likewise the income statement will separately identify the net income attributable to each. In computing the ROE, we use the net income attributable to the company's shareholders and average equity attributable to company shareholders, which excludes the non-controlling interest. In this learning objective, we will disaggregate return on assets into profitability and productivity and analyze both. Managers can increase ROA by increasing profitability for a given level of asset investment or by reducing assets invested to generate a given level of profitability, or both. We can gain insight into these two drivers by disaggregating return on assets into two components to isolate the profitability and asset investment levels. The first component is profit margin, calculated as net income divided by sales, and the second component is asset turnover, which is calculated as sales divided by average total assets. This slide shows the disaggregation of return on equity into return on assets, profit multiplied by financial leverage. Managers usually understand pricing, management of production costs, and control of overhead costs. Fewer managers understand the role of the balance sheet. ROA forces the managers to focus on the returns achieved from assets under their control. The last part of the analysis assesses the level of financial leverage, which increases the risk of default and bankruptcy and therefore must be managed effectively. The first level of analysis is the calculation of return on assets and financial leverage. However, beneath each of the components of the DuPont analysis components, we see other ratios that can be calculated as a second level of analysis to provide further insight into the company's performance. The additional ratios will be discussed in more detail throughout the module. We will begin in this module with profitability ratios, which include the gross profit margin, operating expense margin, and overall profit margin. Profit margin is what the company earns on each sales dollar. A company increases profit margin by increasing its gross profit margin and/or reducing its operating expenses as a percent of sales. Asset turnover will be discussed next and is the sales level generated from each dollar invested in assets. A company increases asset turnover by increasing sales volume with no increase in assets and/or by reducing assets invested without reducing sales. The goal is to increase the productivity of the company's assets in generating sales and then to bring in as much of each sales dollar to the bottom line or net income. In analyzing profitability, we know that profit margin, while an important measure of profitability, is influenced by gross profit margin on sales and selling, general, and administrative expenses. Consequently, we gain insight into profitability by separately examining gross profit margin and the selling, general, and administrative expense margin. Gross profit margin is influenced by both the selling price of a company's products and the cost to make or buy those products. We generally prefer gross profit margin to be high and increasing, as the opposite usually signals more competition or less appeal for the company's product line. A decline in gross profit margin deserves further investigation and can be due to a variety of factors such as those shown on the slide. The operating expense margin, also referred to as SG&A expense margin, measures general operating costs for each sales dollar. These costs include all costs other than those to make or buy the company's products. For 2018, the median SG&A expense margin for S&P 500 companies was 16.3%, and that margin has declined steadily from a high of 19% since the economy emerged from recession in 2009. Analysis of operating expense margin focuses on each expense in whatever detail the company provides in the financial statements. We compare the operating expense margin and margins for each of its components over time and against peers, making sure that peers have similar business models. We investigate deviations from historical trends or benchmarks to uncover the cause. Caution is advised, though, if a company cuts research and development, marketing, or compensation costs to improve profitability. There can be short-term improvements but cause long-term effects such as reduced market share or damaged employee morale. The next component for analysis is productivity, which is measured at the first level by asset turnover. Within asset turnover, we have other components such as working capital. Working capital component ratios include accounts receivable turnover, inventory turnover, and accounts payable turnover, which compare the activity on the income statement to the associated balance sheet accounts. Turnover, while widely reported, has limited usefulness. For example, it is not easy to see how much cash is generated if accounts receivable turnover improves. It is more intuitive to think of the average days to collect accounts receivable, sell inventory, or pay accounts payable. Therefore, we compute annual measures of each of the turnover ratios by dividing them into 365 days to determine the days sales outstanding for accounts receivable turnover, days inventory outstanding for inventory turnover, and days payable outstanding for accounts payable turnover. When we add all three of these together, we have the cash conversion cycle. The cash conversion cycle measures the average time in days it takes to sell inventories, collect the receivables from the sale, pay the payables incurred for the inventory purchase, and return to cash, which we discussed in Module 2. Each time a company completes one cash conversion cycle, it generates profit and cash flow. Companies generally prefer low cash conversion cycle because the operating cycle is generating more profit and cash flow. We analyze trends in the cash conversion cycle over time and in comparison to peers with similar business models for deviations. Diversity in the cash conversion cycle occurs across business models, as is evident in this graph for the cash conversion cycle for selected industries in 2018. The variability in the cash conversion cycle across industries reflects fundamental differences in business models. The cash conversion cycle for the healthcare industry, for example, is much longer as a result of the extended period of time required to collect receivables from third-party payers such as insurance companies and the government. In contrast, the utilities industry's quick cash conversion results from lower levels of inventory and paid collection of receivables from customers who typically pay their utility bills within a month. This slide illustrates the cash conversion cycle for Merck & Company over time. We see an improvement over the 2016 to 2018 period. The improvement in Merck's cash conversion cycle from 2017 to 2018 reflects improvement in all three working capital accounts. It is collecting receivables more quickly, selling inventory faster, and delaying payment on payables. Each improvement generated additional cash during the period. To compute the amount of cash generated or used by changes in each of the measures, we multiply the change in the number of days by the related income statement account measure, sales or cost of goods sold per day. The table shown on this slide illustrates these measures. Although these trends for Merck are favorable, we must investigate whether they are too favorable. Companies can generate cash by restricting credit policies, by reducing the depth and breadth of their product offerings, and by delaying payment to suppliers. All these actions can generate a short-term inflow of cash at a longer-term cost of market position and supplier relations if not managed properly. These questions must be answered by a review of non-financial information in the MD&A section of the 10K, listening to conference calls with management, reading the financial press, and reviewing analyst reports. The asset class for which analysis of turnover is most useful is property, plant, and equipment. Lower levels of property, plant, and equipment turnover indicate a higher level of capital intensity. PPE asset turnover differs by industry. Because investment in property, plant, and equipment assets is often a large part of the balance sheet, improvement in plant asset turnover can greatly impact the company's return on assets and cash flow. Improvements in PPE turnover are not easy to achieve. They often require divestiture of unproductive assets or entire business segments, joint ventures with other companies to jointly use PPE assets, divestiture of production facilities with agreements to purchase finished goods from the facility's new owners, and buybacks, lease and sell and leaseback of administrative buildings. As companies utilize a large proportion of borrowed money in their capital structures, they incur obligations for interest payments and the repayment of the amount borrowed, the principal. These obligations are typically evidenced by a loan agreement or bond indenture that contain various restrictions on the company. Judicial use of financial leverage is beneficial to stockholders as it is a relatively inexpensive source of capital, but the borrowed money adds risk as debt payments are contractual obligations. Analysts typically involve ratios that investigate the level of borrowed money relative to equity capital and the level of profitability and cash flow relative to required debt payments. Although there are dozens of financial leverage related ratios in commercial databases, the two ratios shown on this slide, total liabilities to total equity and times interest earned, capture the spirit of such analysis. Return on assets is typically under the control of operating managers, while the capital structure decision is not. Accordingly, a common adjustment made to the numerator of ROA is adding back the net After-tax interest expense, which is net of any interest revenue or other operating expense or revenue reported after operating income. The ROA for Boston Scientific, after making the adjustment to remove the after-tax net interest expense, is 8.88%, which is slightly higher than the ROA calculated previously of 8.35%. Note that the tax rate used in this calculation is the statutory tax rate, which is equal to the federal statutory tax rate plus the state tax rate, net of any federal tax benefits. The adjusted numerator better reflects the company's operating profit as it measures return on assets exclusive of net non-operating expense or income. Another adjustment is made to ROE when equity is near zero or negative. Stock buybacks have increased dramatically over the past several years, such that many balance sheets report large levels of treasury stock. The effect of treasury stock on key ratios is material for many firms. For example, ROE for Johnson & Johnson with and without treasury stock is shown on this slide. For many firms, the effect of treasury stock has two challenges. Small equity balances occurring from treasury stock buybacks create a small denominator in ROE calculations, which inflate ROE. Negative equity balances can even occur when stocks are repurchased at prices that have increased markedly, such that the cash received to repurchase stock is large compared to the cash received from stock issuances. There is no easy solution when equity is near zero or negative. Instead, a few practical means utilized by analysts when confronted with this issue are to either use metrics less sensitive to low or negative equity, such as ROA, or to compute ROE after adding back treasury stock, such as was done with the Johnson & Johnson example on this slide. And this is the end of Part 1 of the presentation for Module 3 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.